Welcome to the Retirement Learning Lab, where we help you to navigate the journey from insecure to in control in your retirement planning. I'm your host, Van Richards, and today we're diving into one of the most misunderstood aspects of retirement planning. That is how your Social Security benefits are taxed. And I have some potentially great news about a proposed $4,000 tax deduction that could save many retirees thousands of dollars each year. Well, with that said, let me ask you this question. Did you know that your Social Security benefits might be taxable? If you're like most people that I talk to, you're probably thinking Social Security is tax-free. After all, you've already paid taxes on that money when you earned it, right? Well, I hate to be the bearer of bad news, but that's not necessarily true. And this is a misunderstanding that's costing a lot of retirees thousands of dollars every year in unexpected taxes. But before we dive in and get too deep into this, I want to mention that everything that we discussed today is purely educational. It's not investment advice and it's not tax advice. Always consult with your tax professional for your specific situation. Let me share with you a conversation that I had recently with a client. I'll call her Margaret. She's 70 years old and just started receiving her Social Security retirement income. And she called me in a panic. She said, Van, I just had a conversation with my accountant and she said that my IRA income, along with my Social Security, is going to cost me an extra $3,400 a year in taxes because Social Security is taxed. How in the world can that be? Well, to make a long story short, we ended up shifting some things around for Margaret, and I'm going to tell you a little bit more about that in a moment. But I want to stress that Margaret's story is not that unique. Here's what most people don't realize. Up until 1984, Social Security benefits were actually completely tax-free, but that all changed. Now it's up to 85% of your Social Security benefits can be subject to federal income tax. Here's the shocking part. You see, back in 1984, less than 10% of Social Security recipients paid taxes on their benefits. But by 2015, that number had jumped up to 52%. And it's projected that 56% of beneficiaries will end up paying taxes on at least some of their Social Security benefits going into the future. And it's actually only going to go up unless things change. Let me explain. Why this dramatic increase from 1984 up until 2015? Well, it's because the income levels that determine whether your benefits are taxed or not hasn't been adjusted for inflation since 1984. What seemed like a high income back then, well, it's middle class now. So how does this taxation actually work? It's more complicated than it should be, but let me break it down into 3 simple steps. Step number 1, you calculate your combined income. This is where it gets just a little bit tricky, so hang on. Combined income isn't just your regular income. It's calculated like this. You take half of your Social Security, that is 50% of your Social Security benefits, plus your other taxable income. That means your pensions, your wages, your interest, your dividends, plus tax-exempt interest is included in this calculation too, like from municipal bonds. Let me give you a brief example. Say that you and your spouse receive $30,000 a year in Social Security benefits, and you have $25,000 in other retirement income, and then $2,000 in tax-free municipal bond interest. You see, your combined income would be the $15,000, because remember I said they only count half of your Social Security, 50%, plus the $25,000 in other income that we talked about, plus the $2,000 in interest from the tax-free municipal bonds. That all adds up to $42,000. Then we move on to step number 2. You check your thresholds. Now, so that we are both on the same page, let me give you a simple explanation of what a tax threshold is. You see, tax thresholds are the income levels at which different tax rates or rules kick in. Now, there are 2 important thresholds, and they depend upon your filing status. You see, if you file married, then your base threshold is going to be $32,000. The second threshold is going to be $44,000. For single people, the income levels are a little bit lower. The base threshold is $25,000, and the second threshold is $34,000. Let me kind of round that out for you so that you can understand, because I know that there's a lot of numbers flying back and forth here. If your combined income is below the base threshold, none of your Social Security is going to be taxed. If it's above the base but below the second threshold, up to 50% of your benefits can be taxed, that is. If it's above the second threshold, up to 85% of your benefits can be taxed. Now, we move on to step number 3. This is calculate your taxable income. Now, this involves 3 calculations, and you could use whichever gives you the lowest number. Now, I'm not going to bore you with all of the math, but to keep it simple, the $42,000 in combined income that we just talked about would end up paying $5,000 of their $30,000 of Social Security benefits. But here's where it gets really painful. Let's say that same couple made $65,000 in combined income, the taxable part. They would pay taxes on $23,850 of their $30,000 of Social Security benefits. Almost 80% of their benefits would be taxable. Now, it also depends upon what your tax bracket's in about how much income tax that you would pay. That's why that you need to talk to your accountant, because it's different with every person. Now, here's where some potentially great news comes in. There's currently a proposal being discussed that would allow $4,000 in annual tax deduction specifically for Social Security recipients. Now, this isn't law yet, but it's worth understanding. You see, they're still talking about this in Congress. For someone in the 22% tax bracket, a $4,000 deduction could save them $880 in federal income taxes. Now, for a couple who's filing jointly, both spouses receive Social Security, that could potentially be $1,760 in annual savings. So we went back and we added that $880 twice, since both of you are receiving Social Security, and that added up to the $1,760. The key word here is potentially. We don't know if this will become law or not yet. What the specific requirements might be might change, but it highlights the importance of staying informed about tax law changes that could affect your retirement. So, what can you do about this? There are 3 strategies that can help you to minimize your taxes on Social Security. Strategy number 1, manage your income sources. Remember, certain types of income don't count towards your combined income calculation, like Roth IRA withdrawals, reverse mortgages, and life insurance loans are all tax-free and won't increase your taxation of your Social Security. This is why I often recommend clients to consider Roth conversions before they start taking Social Security. It can really save them thousands of dollars in the long run. Now let's talk about strategy number 2. Time your income. And this is what I did to help Margaret that I was just telling you about a moment ago. If you're still working or you have control like Margaret did over what retirement income that you take, that is from retirement distributions like from 401k or from pensions, consider spreading that large income out over multiple years. Taking a big 401k distribution in 1 year could push you into that higher tax zone. So you don't want to do that. Spreading it out can be very helpful to you. And then strategy number 3, consider geographic tax planning. Yep, that's a thing. Here's something that many people don't know. About 40 states don't tax Social Security benefits at all. If you're considering relocating your retirement, this could be a significant factor. But here's a pro tip. If you're looking at how a state taxes Social Security, also consider how they tax income from pensions or other retirement accounts, because some states do have a special tax on those types of accounts. Now, the bottom line, though, is Social Security taxation is complex, but with proper planning, you can minimize its impact on your retirement income. Now, I know this can feel really overwhelming. Social Security taxation is just one piece of the retirement planning puzzle, but it's an important piece that many people overlook, and they don't start looking at it until it's actually too late. That's why I've created a complete Social Security planning guide that really walks you through not just taxation rules, but also claiming strategies, spousal benefits, and how to maximize your benefits over your lifetime. Now, you can download this for free at socialsecurityguide.richardsfinancialplanning.com. Again, that's socialsecurityguide.richardsfinancialplanning.com. Remember, the goal isn't just to understand how Social Security is taxed, is to use that knowledge to make better decisions about your overall retirement strategy. When you understand all the rules, you can plan accordingly and avoid those surprise tax bills, kind of like Margaret had experienced. The key is this. The key is moving from being insecure about these complex rules to being in a situation where you are in control of your retirement situation. And that all starts with education and proper planning. Now, if you found this helpful, please subscribe to the Retirement Learning Lab and share this episode with anyone who might benefit from understanding Social Security taxation better. I'm Van Richards, and remember, the path from insecure to in control starts with understanding the rules of the game. Thanks for listening to the Retirement Learning Lab.